The latest CPI print, that's the Consumer Price Index for June, coming out today cooler than expected. And that slowdown could be what the Fed needs to start cutting rates. For more, we're bringing in Seth Carpenter, Chief Global Economist at Morgan Stanley. Good to see you, Seth.
Great to be here. Thanks
for being in. So the thinking now, at least the consensus, is coalescing around a cut in September and perhaps one more cut before the end of the year. Is that in line with how you guys are thinking of it? And was this that data point that the Fed needed?
This is definitely one of them, but it's good to remember, go back a month and we had another CPI print that surprised consensus to the downside as well. Our baseline is and has been for a while 3 cuts this year. And before last month's print, the amount of hate mail we would get was incredible. And I said, just wait for it. And then we got last month's print and people started coming around saying, you might be right, but boy, 2 is probably as far as it can go. We get today's print, and I think you'll see market pricing is actually creeping even further. So the market's pricing in a little bit more than 2 cuts for the rest of the year so far. We think they get there. Some of the communication from Fed officials today has been, I think, in the same direction. I thought Chair Powell's testimony this week was really important, where he said, we've seen some progress. He called the progress on inflation modest, but that was before today's data. But he also said, we have to pay attention to both types of risks. If we stay too high for too long, we put at risk employment. And so I think what today's print does both gives them that much extra confidence inflation's coming down. And if they do start to see any signs of weakness in the real side of the economy, they've got greater latitude in order to be able to react to that.
Let's talk about that labor market, Seth. I'm curious to get your take, because it is cooling. But when you look at the labor market, are you concerned?
Concerned, no, but I will say the job market report from last month, I've been telling people it's like a Rorschach test. Whatever was already in your mind, and you look at the print, you can see it there. So I look at the headline number, 200 or so. That's a pretty solid number. Definitely cooler than where we were 6 months ago, a year ago, 2 years ago for sure. But by all counts, 200 jobs per month is pretty good for the U.S. economy. The private number, which is probably giving you a better signal on where the actual market-based economy is going, was even softer than that, and it has been decelerating for the past couple of months. But if you sort of open the aperture a little bit and go back a year or two, you see that sort of has been going up and down. It's been trending down a bit, but it's not falling off of a cliff. So yes, we think they're slowing in the economy. Yes, the labor market is not as tight as it was before. But that's a good thing, and that's very much by design. That's what the hiking by the Federal Reserve was designed to do, was to put the brakes on just a little bit to the economy.
There's another area of the economy where there was a little relief in CPI today, and that was shelter costs. But you guys recently put out some research looking at housing in the U.S. that I thought was really interesting. And among other things, it pointed out the gap between people who have mortgages, who are in their homes already, and then, as we see there on the right side, the tick up in the actual mortgage rate if you're buying a home now. Unfortunately, Josh is keenly aware of this right now. So Seth, even if rates now start to come down, what's going to be the lag effect for the housing market? How long is it going to take that to really recover?
It's a great question, and so shameless plug to my colleague Jim Egan, who's our housing specialist, fantastic, and he and I spend lots of time talking about this. The first thing is we came to this from the inflation side of things, and it's really important to separate the current housing market, especially for things like new homes or existing home sales and things like that, from the inflation data. They're very, very separate. The inflation data come from quotes the BLS gets on actual rents. And so the fact that that part of inflation is coming down, and we think will continue to come down for the rest of the year, that's actually not much of a surprise, because we can look at the actual data on rents and it tells you very clearly where that inflation is going. The housing market, current housing activity, is driven by lots of things, mortgages, especially available supply. So what's likely to happen? We don't think, even with our forecast of the Fed cutting rates more than what's in the market, it's going to be enough to really move that, on the chart that you showed, the sort of average effective rate for people down to anything like where other people are right now. It'll bring things down for sure. Long-term interest rates can come down. It'll help with mortgages. But the majority of people who got 30-year fixed-rate mortgages back in 2021, 2022, they've got a mortgage that starts with a 2 or a 3. We're a long way away from that. So we think the housing market's going to move mostly sideways. Think about a bull case, a bear case. It's probably single digits, either up or down. And I don't think the cutting from the Fed that we expect to happen over the next, call it 6 months to a year, is really going to be enough to move that needle.
Let me ask you something. We got some earnings reports today. As you look through the reports, you listen to the CEOs, and they talked about the consumer. There were some reasons for caution. It had kind of a cautious tone to it. I'm just curious your take on the American consumer. Where are we, Seth? Where are we headed? Are you nervous?
Nervous. Not particularly nervous, but if you meet an economist who's not sort of on alert, then they're not doing their job. I think in the same way that I was talking about the job market, we're seeing cooling. I don't think anyone can argue with that. We're seeing some normalization. If you go back a year, 2 years, the consumer was on fire. The purchases in particular were heavily skewed towards goods. That's normalizing. And so if we look at the data so far this year, much weaker demand for consumer goods, but some of that is just payback of wallet share from the bad old days of the pandemic when people were going out much less and spending on goods. So there's definitely that slowing. We don't think we're going to fall off of a cliff. There's going to be some segmentation. The upper end of the income distribution absolutely still spending, especially spending there on services. And I think that's part of what's going to keep the economy chugging along, why we can slow without crashing. And so it'll be a fractured consumer. The bottom end of the distribution, you see delinquency rates drifting up a little bit. Their wage gains have slowed down compared to where we were a year ago. So definitely some slowing, definitely some spread in the distribution, but I don't think we're at the point where we're looking at the consumer just coming to a halt.
And you are, as we mentioned at the top, the global economist. So I always like to ask you a little something aside of the U.S. We've got NATO meetings going on right now, but there's been a lot of attention on Europe and the elections that just happened there. Are you thinking about any sort of economic repercussions from those elections? I mean, particularly in France, for example, where there's been a lot of talk that Emmanuel Macron won't have the economic mandate that he has had.
No, absolutely. And I have to say this year is a remarkable year from beginning to end in terms of elections all the way around the world. We had, India, really big economy with an important election and several others. For France, one of the places where the market's really been focusing is what happens with the fiscal situation. And sometimes you'll get fiscal situations where if you have a fractured government without a clear mandate, much less gets done and you can get fiscal consolidation. The risk, on the other hand, is to bring people together and to get anything done, you have to say yes to everyone. And so one of the places where initially, I think, after some of the preliminary elections, including for the European elections overall, the market started paying attention was, are we going to see some sort of fiscal loosening? And you saw it show up in oat spreads. Right now, we're at the place where we're waiting to see what sort of government gets formed, what the plans are, because I do think it will be very, very challenging for Macron not having sort of if he's not able to assemble enough of a coalition to really drive forward his own plan.
Yeah, we'll see.
All right, Seth, we're always lucky to have you on the show. Thank you for joining us. Appreciate it.
Pleasure to be here.